Welcome to the PlanStrongerTV market update for Wednesday, August 19th. Quick look at the numbers. There are your 2025 total return numbers, and we recap those as we do each update to provide a background and context for the year-to-date numbers. Let's roll into those. You'll see the Dow doing well, up 12%. Raw numbers again. I know I say this every time. These are raw, not annualized numbers. How much have we done so far this year? 12% for the Dow. Total stock market index, almost 14, S&P 13, NASDAQ 13.5. Small caps, the standout again, continuing to be ahead of the pack with a 22% year-to-date return. That's impressive. Foreign stocks, a little behind, but I'll take 16% any day of the week and twice on Sunday. And then bonds, basically flat. Okay, with the table set, we're going to talk about something we haven't discussed that I can think of. And Robert, you may recall we may have spoken about this in the past, but not really had an opportunity to dig into it. So we're going to talk about capital investing. What does that mean? And so, and how is it different than, say, manufacturing or other things that we may hear about? So capital investing.
Yeah, more the balance sheet term, the corporate speak term is capital expenditures. I just say, capital investing in capital, and it's for really any mom and pop shop, small caps, your mega caps, Apple. When you purchase goods that will last more than usually a year, that's utilized to generate income for your business, you're talking about capital expenditures or capital investing. And David brought up manufacturing. We just spoke about manufacturing specifically, I believe, last week, about how manufacturing has come above expectations. Manufacturing is more kind of a subset of capital expenditure. So of course, manufacturing companies have to, invest in, new goods and equipment and everything. But really, any company, even service companies, you show me a company that doesn't use a computer, a personal computer, or a phone for their employees. So, any company can spend money on capital expenditure. So that's what we mean when we use that term.
Well, we hear a lot about capital expenditures in the context of these AI data centers, or all this, or the chip manufacturing. We hear a lot about that in the technology area, and that's driving this big infrastructure build out and all the companies that feed into that. But that's not an isolated thing. We're seeing it in other parts of our economy as well, aren't we?
Yeah, absolutely. So that's kind of, I'd say one of the themes throughout this year as we've been doing these market updates for our viewers is that, it's not all about AI. It perhaps started with AI, and AI is kind of the elephant in the room. But as the years progress, we are seeing the spillover effects of the investments into AI, into the broader economy, and then into, again, small caps, mid caps, all different size companies benefiting from that. And, one thing I might add is that, back, a year and a half, go back a year and a half with the tariffs, the Liberation Day tariffs, it just seems like yesterday, but, the deals that this country has made with other countries in terms of, look, your tariffs were this high, we're going to put these tariffs on, but we can reduce them if you promise to invest in the United States. Well, that has happened. So it started with AI, we have these major building projects here in the United States, spills over into the further industrial economy, and that creates jobs for the worker. So what we're seeing is the spillover effects of that, and the capital expenditures. The few figures that came out the last couple of days have, and I'm not going to bore you with the numbers, but across so many different categories, an increase in the percentage that companies are spending to increase their capital investments.
I don't know if the camera caught me. I went like this when Robert said that. He beat me to it. I was going to say, so Robert, how about the capital investment that has been negotiated by the Trump administration with regard to the tariffs? And perfect answer, Robert. That's very good. And so the question about that then is that Is that a one-time shot in the arm like adrenaline, or are those capital investments multi-year deals by foreign countries who have agreed, or foreign corporations who have agreed to make this capital investment in the United States? Is that ongoing? Do we see that sustaining? Or was it really just a one-time thing?
Well, when you say one-time thing, a country doesn't throw in, let's just say, $100 billion. The factory goes up overnight, and it's a one-shot done deal. That factory stays where it was built. The workers continue to work there for several years, several decades, and the important thing is, again, back kind of an important concept with tariffs, is that tariffs do two things. It incentivizes foreign countries to build their products here, so they're not subject to tariffs, number one. Number two, countries that want to flood the markets like China, well, guess what? You're going to pay a steep tariff if that flood of goods is going to come into the United States. So it kind of protects on both the domestic and the foreign end. But in answer to your question, you can look at it as the announcement is like, okay, a one-shot deal, but putting it into practice on several fronts, no, it's an ongoing
Well, the
investment.
economic benefit is sustained because, again, your
Absolutely,
factory
yes.
example, you've got the factory and you've got workers that have been hired to build, the automobile or whatever it is in the United States. That has a long-term stimulative effect. And the other thing, we have talked about multiple times, and we will talk again in the context of interest rates over the upcoming updates we do for you. We're going to talk about interest rates and inflation. It's coming back. We will talk about that more. And I think that we sometimes overlook the impact that these tariff-related capital investments are having, because there's only so much goods and services at a given moment before then, before the economics can adjust. So in other words, you can get inflation by more demand than what's available for product and service. That's what is in part drives inflation.
Correct, yes.
So I'm setting the table, if you will, that we shouldn't be surprised when we see inflation numbers coming up. We should be surprised if we see inflation going to 1% or 0.
Right, yeah.
Did I steal you? Did I?
No, not at all.
Sometimes Robert pauses and I'm like, what's he thinking? Did I steal his idea? Or was he like, wow, that was pretty good, David. I'll take the latter. Okay. All right. So how about the impact then on investors' portfolios of this entire area that we're discussing around capital investing?
Well, so the most obvious answer is, of course, with an increase in demand, companies aren't going to spend money and give money to other companies to provide them capital goods if, number one, the demand is not there, and number two, if they see a recession or a downturn happening in the near future, they're not going to spend the money. So that portends well for the economy, number one. And, if they're spending money to increase revenue, that's a boost for stock prices. So that's kind of the obvious answer, that stock prices would do well. But also another item, I'm going to talk about corporate finance and the corporate balance sheet. When corporations spend money, it's not, sometimes they take it from, the pot of cash they have, but oftentimes they issue debt. And that is when companies and multiple companies are issuing debt to get money that way in order to fund capital investments. You have your bondholders, or you have a broader kind of pot to pick and choose your debt securities to enhance your income. Because a lot of our clients, they're not all equities. People have 50% bonds, 50% equities, or 75% fixed income securities. So people are looking for those products, and bonds don't come out of thin air. They're not just issued by the government. Corporations, corporate bonds, and this is the process through which they issue those bonds. And, just kind of to bifurcate them, to separate them, you have your investment grade, and then you have your, higher yielding kind of riskier bonds. Usually a big chunk of those are like energy companies, but keep in mind, the companies that issue these high yield bonds, their balance sheets are a lot stronger than they were back in 08 and 09 during the great financial crisis. So, high yield bonds, they're riskier than their investment grade, but overall, corporate balance sheets are pretty healthy.
Okay.
I'm sorry, that was a mouthful, so I think I
good.
overwhelmed
That's good.
David.
That's good. It's always good to get Robert's insight. So we will continue to monitor that inflation, investment, and interest rate. That those three pieces, and of course coming into this is also the employment numbers. And so, but I think a key takeaway I would take from what Robert shared is that companies are not going to go borrow to invest in making these capital investments and further building their economic engine if they don't expect demand for their services
Exactly.
or products. So, all right, final thoughts?
No, I think
That's good?
That was a great cap. Yep.
All right, well then that's good. That's good. We'll wrap right there. Lots more to come, you could tell, and we'll continue to follow these things and bring them to you and distill them a little bit, talk about them, and help you continue to plan stronger.